Hey everyone, and welcome back to the Rate of Return podcast, a 30-minute podcast whose entire purpose is to equip you with the tools and resources to become the best financial version of yourself. From investing in the stock market or real estate to cleaning up your personal finances, putting you on track to become a millionaire, the Rate of Return podcast exists to give you actionable insights you can work toward today. Joining me are the co-founders of Quantbase, Som Mohapatra and Thomas Stewart. As an Eccles Scholar at the University of Virginia, double majoring in economics and computer science, Som took a step back from college to build a high-risk investing solution. While at Virginia, he became a portfolio manager of the school's McIntyre Investment Institute, a long-short equity investment organization with $1 million in assets under management. He's also a fellow at Contrary, a venture capital backed by founders from Tesla, Airbnb, and Facebook. He's accompanied by Thomas Stewart, a graduate of UVA, double majoring in math and economics, with a stint at the coveted Princeton University studying algorithms. Thomas's experience include being a software engineer at Apartments.com, an AI developer at Abion, a software engineer researcher at UVA's High Energy Physics Lab, and he's already got a past startup exit under his belt. Som, Thomas, I'm glad I said everything right. I'm glad I didn't mispronounce any of these insane just accolades and backgrounds that you guys, experiences, right, that you guys have done. Thanks so much for joining us.
Yeah, thank you for having us. We try to make it hard with the names. Avion, going crazy there.
Totally. So, all right.
Austin,
sorry. I think it was muted there for a second. Sorry about that. Yeah. All right, so we'll cut all that part out. We'll reswitch. Boom. The world's first SEC registered robo-advisor for high risk investing. That's insane, right? So would you all mind walking me through how you got here and why you started Quantbase? Like, what is Quantbase? Give me the play-by-play.
Yeah. So it's a pretty winding journey to get where we are now. Of course, where we are now is we're an SEC registered, fully funded, VC-backed solution, a robo-advisor for high-risk investing. So what we do is we offer retail investors a minimum investment of $50 in these automated portfolios covering everything from crypto, leverage investing, quantitative investing, sentiment investing, NFTs, fine art, alternatives increasingly, just to make it as simple as possible to get high returns with the expectation that you're going to have more volatility in the short run. So we've already had a wait list of about 5,000 excited retail investors, and we just recently launched, actually, in early February. So working out the kinks, bringing people on, and just having a ton of fun.
Congratulations! And as I remember, when we were talking back in the day, it could be Som, maybe it was Thomas, but one of you were posting to Wall Street Bets talking about just hey, we have these ideas that, the stock market's cool and all, but what about everything else that's out there to invest into, right? So Som, you actually tweeted an image. It's of the average investments of what investors need to, the investments people need to be making in order to earn 7% annually. And so back in 1991, it was a lot of cash with a little bit of fixed income, and you were making 7%. In 2006, it was a majority of fixed income and then a little bit of cash in U.S. stocks and non-U.S. equities. But now in 2021, it's a lot more complicated, right? Just to earn the same 7% that you were earning in 1991, you now have to have U.S. equities, non-U.S. equities, real estate, private equity, so on and so forth. You mentioned all these different things that Quantbase allows investors to invest toward. Do you mind adding some more color on that? Do you see this trend continuing? Give me the play-by-play around your thoughts on how you growth hacked and sort of got some more information from people's sentiment on Wall Street Bets, as well as how you're trying to paint this future picture of what Quantbase is and what it unlocks for investors.
Yeah. So as far as the returns from the S&P kind of decreasing over the long run compared to the last 100 years, and it being harder to get that passive return, absolutely, right? And here's kind of the mental framework that Thomas and I kind of have that leads us down the path of Quantbase. So if you look at the returns for the S&P, which is really the general U.S. stock market, if you look at those returns since 1928, we've had about 8% annualized returns. So the constituent stocks of the S&P have about 500x'd in the last 100 years or so. So if we take that kind of return profile and then forecast that to the next 100 years, for this trend to even continue by half, aka 4% annual returns, the market cap of all S&P stocks would have to hit over $50 trillion. That's pretty crazy. We're not saying it'll happen or it won't, but it's just a really, really hard number to fathom. And, adding to this, over the past 40 years or so, there's been this kind of new paradigm that passive investing in the general stock market, aka just Vanguard ETFs in the S&P, are the best way to accrue wealth, right? That's the idea that pretty much all robo-advisors today are based on. But it's not something that's set in stone, right? There's nothing that says investing easily in the stock market is going to make you incredibly wealthy, right? For example, look at a number of stock markets outside of the US, right? My favorite one to look at is the Nikkei, which is Japan's national index. They are still 26% down from their all-time high back in 1989. So, investing in your general stock market isn't always the path to success, the path to wealth. So institutions know this, and that's kind of the tweet that you called out here earlier. Pretty much all endowments, sovereign wealth funds, and other large holders of capital, they've diversified their investments across a large array of assets, right? Bonds, stocks, as well as alternatives like hedge funds, private equity, etc. So what institutions know, and what we're trying to really set in stone for the rest of the world here, is that in order for the regular person to make crazy or normal returns, the returns that we've gotten used to, in order to continue making them for the next 50 years, we're going to have to take on higher risk than your general stock market, right? And that might mean doing more active investing, like picking the right stocks, picking the right options, dumping all your money in Dogecoin or Shiba coin. But if we want to get kind of that all takes skill, that takes effort, that takes time, right? If we want the same kind of passive investing, the ease of investing in the S&P, but kind of the higher return that we've gotten used to, it's time to start investing in alternatives. And, one thing I want to mention here real quick is there's a really, really interesting opportunity here. Because of all these fintech and invest tech companies that are proliferating, people retail investors like us have more options than ever before. We can invest into, your hedge fund portfolios and private equity portfolios like the ones Quantbase offers. But we also have this opportunity to invest in kind of assets that even hedge funds and institutions don't have access to, right? I'm talking about asset classes like creators and athletes. I'm talking fund strategies like Wall Street bets tracking, and then also certain movements in DeFi, NFTs, et cetera, that are just too small or too fast moving for institutions to really get in on. And that's what we're most excited for here at Quantbase.
I love that. And that last point you there, right? We're going to get into questions about, there's stuff that we're going to talk around with other hedge funds and their strategies. But something you mentioned around is it's too small or too fast moving for these hedge funds to jump in. And you say that knowing that, these hedge funds have tens of billions, if not hundreds of billions of dollars. If you drop 100 billion or even 1 billion into any of these smaller sort of asset classes that you alluded to, Som, the prices go crazy and there's no more, arbitrage or, it's not undervalued anymore, right? So you're saying that the Quantbase can easily, kind of pivot and be agile enough to identify what those are and deploy a meaningful amount of capital toward it?
100%.
Love it. I love it. Yeah. It's investors, everything you're just talking about, right? Investors needing to take on more risk to achieve the same. It's really frustrating. Kind of looking back, you're just like, dang, man, these boomers had it easy, right? All right. So Quantbase, I follow you on Twitter. You guys have made some noise, right? You guys talking about your Nancy Pelosi tracker, this invoice Jim Cramer index you guys are building. Walk me through how you derive this data, how actively these indices are rebalanced. Give me the whole story on, I'm sure there's a lot to unpack here, right? Walk me through it.
Yeah, for sure. So, one of our first kind of guiding principles here is, garbage in, garbage out, right? So if you put in just random data and try to, and put it together in a way that you get high returns, that's not really going to help, because random data, there's, you put in random data and you get random returns out there, right?
Yeah.
And so the way we kind of think about this is, we put probably 80% of our time here into data cleaning, gathering, and pre-processing, right? So we know that the data we have is accurate. All right, so I'll kind of talk through our Pelosi portfolio first, because that's really where we started off our Twitter kind of stint here. We had a number of tweets go viral, and a lot of the engagement on Quantbase has come from people just coming to check out this funny Pelosi portfolio, and then being like, oh shit, these guys know what they're talking about. They're smart. They have the data to back it up. And all that. So, most people might not know this, but the data for like Pelosi and all your other congressional representatives and senators, it's out there. So we get all of our info from publicly disclosed reports from the House's financial disclosure forms. And then from there, for Pelosi at least, what we did was we took all that aggregated data, we sifted out the disclosures related to Pelosi, and then we got to work, right? So the way the data is disclosed, we're not told exactly the amount that Pelosi is invested and like the exact dates, but rather we get, a range of a lot of things. And so that's really where our intuition and the other data that we've gathered comes into play. So pretty much we take an educated guess, and it's guided by a number of factors. I won't get into all of them, but the top three that we take into account are the tightness of the range, right? So like, we see that this person's invested like $1 million to $5 million in Facebook, and then a much tighter range in Microsoft, for example, right? So we have more kind of conviction in a certain kind of play. So that tightness of the range is is one of the factors we look at. Then Pelosi's current exposure to the stock before the purchase or the sale, and then the amount of trading she's done around the time of that purchase or the sale. There's a few other things that go into this. For example, there's a 45-day buffer period between when representatives make an investment and when they are required to disclose it. So, it may be the case that Pelosi or some other representatives have made an investment in the past 45 days that hasn't been tracked.
Or even sold an investment, right?
Exactly. Made investment, sold, or, added to investment. Cramer is actually really fun. That's actually what have you kind of heard about the Cramer portfolio, either ours or like elsewhere on Twitter?
Yeah, I mean, to be quite honest with you, I saw obviously what you guys sent me, but obviously there's so many accounts on Twitter that are saying, or just showing, right? It's like, this is a stock that Jim Cramer has said buy, and it's like, let's all sell it or let's short it, right? And see what happens. You make more money shorting it than if you bought it. So it's like everything this guy says, just do the opposite and you'll make money.
Right. I mean, yeah, the way we kind of think about it is like, if this guy is like so good at making the wrong pick, then he's probably one of the best managers in the world, right? Because like, if you're so consistently like going so one way, like, I read a book a couple months ago that kind of followed some of the best hedge funds in the world, right? The ones that are super famous for making a lot of money, like Renaissance, et cetera. And these companies, they get their bread on making 53% of their predictions being actually accurate, right? And that's such a tiny margin that it's funny that like being wrong consistently like 70% of the time is actually really good. So with that in mind, what we first set out to do was, we're fiduciaries. We have to be responsible about like the investment advice that we dole out and like the portfolios that we make. So instead of just being able to harp on like the wrong predictions that like, Cramer might make, like the ones that all those Twitter accounts out there, like harp on, right? Like Coinbase, Robinhood, et cetera. What we did was we took pretty much a report of all 23,000 picks that Cramer has made since, I think, 2016. Right. So that's like his Mad Money segment. He's got like 10 or 11 different segments within it.
Wow. I mean, you gotta imagine like if you have that many, it's like some of them got it right, bro, right? Some of them got a hit.
It's a full-time job,
Yeah, I mean, it's crazy. Just how many like picks this guy has out there. And, from those 23, we obviously culled a bunch out of there. One of the things we did was we got rid of all the lightning round picks. And so that pushed the number down from 23,000 down to like 8,000. But pretty much that data we ranked from 1 to 5 based on like how positively or highly negative, positively or negatively he was talking about that stock. And what we did was we first did like a few naive tests, right? If we took all of his like, one rated portfolio, one rated stocks and invested in all of them, how would the inverse Cramer portfolio turn out? We did that with the 2s, the 3s, the 4s, and the 5s, right? And what we kind of found was like the 2s, right? The ones that Cramer was like pretty negative on, not like a sell this now, but like you should sell this, right? So we took those stocks and we found that those, like inversing him with the 2 out of 5s, actually beat the market, beat the S&P from, I think, 2016 to 2020.
Wow.
I think if you look at the data now, this is actually, all this information is on our blog post up on our site at getquantbase.com.
All those that are listening right now are watching this, so make sure to include that in the show notes. So just scroll down on whatever app you're on and click the link.
Yeah, exactly. Appreciate that. But it was a lot of fun to make it, and then we sent out the blog post, got a lot of engagement with it. One of the, I think, coolest insights here was, you take your normal Cramer portfolio, or your normal inverse Cramer portfolio, whatever that means, and then you add some kind of quant measures to it, right? Like you risk adjust it, aka you look at kind of the past quarter of data, and then sell out of the most volatile stocks, buy more into the least volatile stocks. And you do all these kind of like, active portfolio management kinds of measures. And that actually made the portfolio like actually good from a financial perspective. So that was pretty freaking interesting.
I love that. So it sounds to me like you guys kind of weeded out the lightning round picks. You've got these 8,000 stocks from 2016 to 2020. You then rank them on how well they performed since then. If a 5's, I'm assuming, the best, a 1 was the worst, and you took all the 2s, so not the worst, but certainly not even like break evens. You took the 2s, you flipped them, you risk adjusted them, and you made an index, and that index has outperformed the market substantially.
It did for a few years. I think now it's just kind of in line with the market, but it's still really interesting how like it's performed against the S&P. It's for all intents and purposes, it's a pretty good portfolio.
That's so cool. That's wow. I can't wait to keep talking about this stuff. We're going to nerd out on this. Before we get into that, it's our halftime show, right? Mailbox Money. This is where I take questions from everyone on my Substack. I've got about 6,000 people hanging out with me over there, and they all have questions for you, and all these guests that I host. So I have 3 questions. I got some. We have Alexa, Harrison, and Simran. Alexa from Connecticut. What's the hardest part about doing a startup in a crowded industry? I want to commit to my idea in women's fashion, but I'm too scared to leave school and fail at it.
Okay. I mean, for that, Alexa, I would say, startups are all about uncertainty, really. Like the whole thing, you're not going to know, like, especially your first idea it's probably going to be wrong, and you're going to find that out pretty fast. But I would say, there's a lot you can do to really de-risk a startup, even when you're still in school. Som didn't drop out until months into Quantbase, until we already had thousands on the wait list, till we had like a fully functional product. He was still in school, still going to class. I didn't quit my job until a lot of the same. So you can do a lot from just talking to people, talking to potential customers, learning about your problem, your market, and then ideally, getting some sales, if that's the kind of thing you can do. And eventually you get to a point where you have enough validation where, and Som and I kind of talked about this, is it's like the more risky option is not doing it. The more risky option becomes staying in school because you realize you have an opportunity here and you really just got to take it.
Yeah. And Austin, I don't know if you remember a conversation, like before I made the decision to drop out, I talked to you and some other folks like, hey, is this a good idea? Like, should I be doing this? And, all the factors pointed to yes, exactly what Thomas was saying. Another thing I want to add is like, if you're in a crowded industry, like the way you might want to be thinking about your kind of positioning, Alexa, is make sure you are focusing on like a niche in the industry, right? So we knew what we had with Quantbase was really, really special when we realized that the niche that we were targeting in this like huge multi-trillion-dollar like just financial space was just the folks that want to get access to high risk, right? And what made us gave us a bunch of conviction was that there's really nothing out there that's doing what we're doing, and there's really nobody else that's better suited than us to give this to them.
I love that. And I know you're not asking me, Alexa, but I'll add my little thing here too. I totally agree with Thomas, right? It's like do as much as you can from both angles. Do school as well as you can, keep building your startup as well as you can. And then like for me, when it was, make that jump to be a TikToker, it's like I had that foundation, like what you guys were talking about, especially you, Thomas, right? It's like we had those people on the wait list. We had these people figured out, right? Had that foundation, then they made the leap. Next question is from Harrison out of Milwaukee. Traditional financial advisors charge 1% fee, a 1% fee on all assets under management. What are Quantbase's fees?
Yeah, so at the moment, we're just a simple 94 basis point just fee on assets under management. That's, of course, right below the industry average, but also, of course, like we're talking about, this is high risk investing. So the kind of strategies we're offering you are, one of our best ones that I, in fact, just moved a lot of money in on Friday is like 30% returns of the last decade versus traditional robo-advisors obviously are a lot closer to 7 to 10%. And that same strategy has done well with data going back over nearly 100 years at this point. So, and yeah, we're experimenting with a little bit more of like fees per strategy. So you're sort of, if you have a 1% fee, it's going to be on a strategy that's doing 20% for the year. So it's very worth it for you.
Got it. So what I'm hearing is despite the industry average being 1% and you guys being close to the industry average, just, still lower, but close to it, you guys are returning 3 times, 4 times as much.
100%. 100%. Yeah. In fact, our CTO, who unfortunately he couldn't be here today, he was doing some research the other day just on high risk investing generally, looking at our strategies here. And he came up with this cool number that if you just put 10% of your investment capital in high risk strategies, just 10%, worst case scenario, you lose it all, it goes to zero, 10% gone. Average case scenario, looking at our strategies, you can retire with twice the retirement money. You can retire 10 years earlier. Potentially, of course, all investments come with risk, and
totally.
The idea is long-term upside, short-term volatility, but you pay that short-term volatility to get significant long-term upside.
I love it. And just for y'all that are thinking like, what are these guys talking about? Don't worry. I got my research ready. We're going to jive like right after we finish up our mailbox money. We're getting into it. All right. Last question here is from Simran from Santa Barbara. I want to invest into riskier assets, but I don't know what to pick. Is it crypto? Is it real estate, leverage funds? Does Quantbase offer any education around each of these strategies so I can learn more before I choose?
Yeah, I mean, it would really depend on your background, your investment goals, your sort of experience with all these strategies. A lot of people we've spoke to who are now users of Quantbase start out, they have like an interest. They've heard about crypto. Maybe they hold some crypto. They're interested in getting high returns. They want NFTs and such like that, but they don't quite get it and how to use it, how to make most effective use of it. And that's exactly what we're trying to do with Quantbase is we want to make the data, the understanding, the asset, the strategy as digestible as possible. So you can come on the site, you can learn about the strategy, you can be confident that this is for you, it's right, it's smart, it's, you have a ton of data to look at, and then you can be confident what you're doing here is going to be great for your long-term portfolio, whether it's in crypto or fine art, NFTs, and you can just click a button and have it run passively. To do this, we kind of have, we ask you a bunch of questions about your goals, your investment interests, what you're trying to do with this capital, and then make some recommendations for you, making it really easy. So
I love it. I love it. It sounds like we're on the same team here, right? We're all just trying to retire wealthier. So let's get into this data, this nitty gritty stuff, right? You guys have a Medium account, which is a blog, and you guys wrote a lot about Jordan Brooks's 50-page paper. This was a incredibly insightful summary. I hadn't read it until I was doing research for this podcast interview. Essentially, you explained how a quant fund was able to realize 13% gains compounded annually over a 46-year time span, including times of war, inflation, and 3 bear markets. Compare this to the 8.6% returns the S&P 500 experienced during the same time period. So like to put numbers around this, people who are like, okay, 13 to 8.5, like what does that really mean? If we invested $10,000 into each strategy, right? 10,000 into one, 10,000 to the other. 8.6. The quant fund with 13% would have turned this initial $10,000 investment over a 46-year time period into $2.76 million. The S&P 500 would have only turned it into $445,000, a difference of $2.3 million. Holy shit, right? That's crazy. So at the end of the summary, that you mentioned that you're building an algorithm to track the strategy. What's the progress? How do people get involved? And where, like, let me put my money in this stuff, man. This is crazy.
Yeah. Thanks for mentioning that paper. Actually, that's really like quant papers like that. These like super academic papers that have these crazy cool strategies, but nobody's offering them for retail investors. That's really what started Quantbase, right? Like Thomas and I are both kind of nerds on this kind of stuff, and before Quantbase, we just read these papers and just kind of dreamed about them, right? And then we realized, hey, we can actually build these out. These are rules based. These are factor based. We can just do it, and so we did. So over the past couple of months, we've been building out like the actual infrastructure for Quantbase, offering these portfolios, getting legal.
Is this portfolio itself like offered? Like, what's the name of this for people that want to visit your website?
Yeah, this one I think is the bear market buffer fund. There's a number of quant funds that we have on the site, or this one might be the global macro buffer fund. So kind of over the next 2 months, we're beefing up the number of funds that we're offering, right? So the way we're thinking about this is really three sets of portfolios. We've got kind of the fun ones that we're offering, the Cramer strat or Wall Street bets sentiment tracker. Then we've got some, really cool industry-leading crypto portfolios, and I actually do mean industry-leading here, right? We've got our vanilla crypto portfolios that like Crypto 10, Crypto 30, Crypto 50 that are going to be offering, market exposure to the top 10, 30, and 50 cryptocurrencies. And then some really, really cool ones like a DeFi index, an NFT index,
nice.
And like investment management across like all these like different chains, right? Like a bunch of my friends, for example, are in the Solana ecosystem. So I talk with them all the time, and like, really we have an idea of like what the coolest people in crypto are doing, and making that stuff investable. And then finally, we're going back to our roots with these quant strats, right? We're really, really pumped about this AQR one. And then as I mentioned, the bear market one and like a hedge fund follower one. I think kind of next on our roadmap is a double index leveraged in and out. So what that is pretty
Holy
much.
shit! You lost me. Double what? What is that thing called?
Yeah. So the portfolio that Thomas mentioned that he has like most of his net worth in, that jumps into like the triple leverage version of the S&P, right? And it jumps in and out of it based on the market. What we're building out now is one that jumps into the S&P triple leveraged. And then in like bad times, it'll jump into like another triple leverage like bond portfolio, right? So like you got double indexes, an S&P index and a bond index, and they're both leveraged.
Is this legal? Like what the hell are y'all building? This is crazy. I love it, dude. Well, no. So, okay, that gets us into our next question, right? So, like, who should be using Quantbase? Like, Thomas, you've got your net worth into it. I mean, as a lot of people on Substack know, I've got a lot of money in stocks, but I also have a lot of money in cryptocurrency and a lot of money just in equity in my home. And I have a lot of money in Fundrise and like all these other different things I'm doing. Who should be using Quantbase? What does that investing journey need to look like for them? What's their risk tolerance? What strategies should they be using? Like, as a percent of their total, is it, you mentioned 10%? Is it 20? Is it fit? Like, what's going on here? And I mean, really speak to the people listening right now as to like, if you are this, go to our website. If you are not this, please steer clear. Like give me like the black and white, who should and who should not.
Yeah. So we've seen a broad range of people that we've spoken to. We've spoken to over 1,200 retail investors to sort of figure out where they are with high risk investing and their investing behavior generally. And we find it's pretty broad around the ages. So it's pretty evenly split between the 20s, the 30s, the 40s, and the 50s. Really drops off at the 60s. I think for sure if you're in your 60s, you should probably not do any high risk investing. But for the
probably,
yeah, right. For the vast majority of people, I'd say it's anywhere from 10% to maybe as much as 50% of your portfolio. The bigger idea here is that you probably shouldn't have all your money in high risk assets, but what Quantbase is doing is making the sort of the $50 trillion of assets that Vanguard, Fidelity, Schwab, Betterment, Wealthfront don't really recognize. NFTs, fine art, cryptocurrency, leverage investing, quantitative investing, all these strategies that are very high return and very volatile, combined with your lower risk, your Vanguard, your Schwab, and so on, make a more optimal portfolio in total. So you benefit a lot from having a portion of your money in high risk investing because it makes your whole portfolio so much better.
Right.
We'd say you can definitely learn more on the site. We do a lot of screening, asking about your experience, your skill level, your goals, to make sure you're getting the right allocation for you. But overall, we'd say the people we've seen the most interested in Quantbase definitely have a slightly higher risk tolerance, and they tend to be upwardly mobile. They're people who are focused on their future, trying to get to the next step, trying to, retire sooner, trying to retire more large. People who, want to keep moving up in life and finding the next best thing. And Quantbase is a way they can just turn things off on their investing side, where they can get this high risk, asset exposure, these high return strategies in a way they don't really have to think about.
Got it. Yeah, I mean, you mentioned these are the robo-advisors. Like Quantbase is not a Betterment or Wealthfront type robo-advisor. You're that are making sure people are well diversified. Like you guys are doing a high risk hedge fund in your pocket type strategy that's unlocking algorithmic investment strategies historically only offered to these ultra high net worth individuals, right? I mean, you mentioned these hedge funds with tens of billions and hundreds of billions of dollars in your blog post with this 50-page paper. I mean, it's wild, right? And so that reminds me, right? It's like Titan. You guys heard of Titan? They're a hedge fund for the people as well. They just raised hundreds of millions of dollars, but I don't see them offering these types of strategies. Is Quantbase like trailblazing a completely separate lane in this like robo-advisor type industry?
Hell yeah. So Titan is really, really cool.
I love it.
Titan's cool. Folks should really check them out if they haven't heard of them. They're essentially, as you said, like a hedge fund manager for the people, right? But Quantbase's model here is totally different. We offer people automated strategies with transparent rules, right? Like you don't have to trust us in the same way you might have to trust Titan or like or some hedge fund or some private equity. What we're offering here is exposure to strategies and asset classes, and maybe even some community tracking like Wall Street Bets. And that kind of stuff you can't really easily get anywhere else.
Yeah, I'd say in many ways, Titan is actively managed. And to be frank, both Som and I think actively managed funds are kind of going the way of the dodo, so to speak. People want the data. They want to know what the fund is doing. They want to know how it performs in different markets. With our funds, we can show data going back decades, showing you in different bear markets, in different market situations. We've had clients reach out to us about the rate hikes going on today with the Fed. How are these funds going to perform in those rate hikes? The most Titan can really say is like, we're monitoring it. We're going to work hard and, do our best. But we can point to, decades of data saying like, the previous rate hikes in 2016 and 2006. You can see what happened with the funds. They were flat. They remained fine. Some nosedive. Some did really well. And you can sort of make those assessments yourself and with our sort of technology giving you a lot of that data and helping you with that. Yeah. So very different.
Yeah, like you can point at the data and then also just like point at the rules, right? Like you can say, hey, this is exactly how this algorithm is going to perform like if this happens.
Yeah.
That is so cool. I'm just so jazzed. I'm so excited to just like explore the life of Quantbase and all the cool things you guys are offering. It's insane. Like seriously, it's wild. And I encourage everyone who's listening to this podcast right now, who is cool with having, like you said, 10% or so of their invested assets, if that's thousands or tens of thousands, probably not hundreds of thousands. I don't think any millionaires, or maybe there are some millionaires listening. Who knows? Maybe there's a lot of millionaires listening. That'd be cool. But anyone who's like, that says, you know what, I want to give this a try. Like check them out. I mean, Som and Thomas here are very smart guys. Please at least read the the blog post that I'll link out in the show notes below, both on the inverse Jim Cramer index, which is just awesome, as well as this summary of this 50-page paper from, I think his name was it Jordan Brooks? Jordan Brooks. So yeah, definitely check him out, guys, if you're listening. And finally now, my sign-off question is a question I ask everyone that comes on board to my podcast. And it's fun to get people's different perspectives. So I want to get yours, guys, right? So looking back in 12 months from now, when people are like, oh my gosh, 12 months ago, this one thing was happening, this trend, this whatever, this one thing was happening. What is that one thing that they'll be talking about that's happening right now that no one's paying attention to?
So something
just so obvious, that obvious one thing no one's paying attention to right now. That's an awesome trend. What are people going to be thinking about 12 months from now when they look back on it?
Thomas and I have discussed this kind of at length, right? And the idea that we really think is incredibly exciting is just like being deliberate about like setting aside a certain part of your portfolio for that high risk, high return kind of mantra, right? I think, Thomas, you mentioned this a couple of minutes ago. 10% of your portfolio, the worst case is it goes to zero. The kind of average to best case is, you retire 15 years early, right? Driven by that 10%. And I think a lot of people are like doing this right now, but they're investing a little bit of money into crypto. They're investing some money into maybe, leveraged stocks or places like Titan. But I think what we're going to see in 12 months is people are really going to be thinking about, okay, here's 10% of my investable capital. And like, I'm going to be really, really like, I wish I'd started being more deliberate about like, here's where this risky money goes, like a lot earlier.
Yeah, 100%.
Okay. I love it. Anything before we sign off? Where can they find Quantbase? Anything you guys want to say to the people?
Yeah, I mean, we're Som in particular is very active on Twitter. He runs the Twitter account. Quantbase_ is our handle there. But otherwise, get quantbase.com. That's where we run things. Take a look, check it out. We have a ton of data on all these different portfolios. So even if you're just interested in looking at the data, come check it out. Very exciting.
Yeah, like the best way to get involved really is to sign up for Quantbase today. Let us know what kinds of funds you want so we can prioritize here. And we're giving the next 3 months free to all folks who sign up through Rate of Return and invest $1,000. So, please check it out. Let us know what you think.
I love it. Very cool. Thanks, everyone.